Hi, I'm Graham, the Insights Manager at finder.com.au. Now, normally I'm on this channel talking about things like the cash rate and economics, but today we have something slightly different. We have a conversation in two parts with Brandon from Aussie Wealth Creation, where he will ask me about investing in the housing market, and I will ask him about investing in the stock market. The stock market conversation will happen in this video. The housing market conversation will happen on the Aussie Wealth Creation channel. You can check the link in the description below. But in the meantime, roll it. So I'm talking to Brandon today from Aussie Wealth Creation. I'm going to be asking him the basics of how to get involved in the stock market in Australia. It's something I don't personally know. We're going to look at the very simple stuff of like how to start buying in the stock market, what to look out for, how you can purchase stock on the market with reduced risk and guarantee a return over time, and how you can potentially look at higher risk stock to get a higher return, the things you need to weigh, the things you need to look at in the future. But let's start off, Brandon, with a pretty basic question. I've got 50k in savings, sitting in a savings account, earning 2.25% right now in 86,400, which is one of the best rates I can get in the market, but still not very good. Are there any ways I can earn more from that cash that's just sitting around?
Yeah, I think a lot of investors are in that boat at the moment. They've kind of just got money laying around and they feel that pressure to get into the markets, especially getting into the stock market, because it's very accessible to anyone. But I think really the first key step in the whole process is for people to just take a little bit of time and really just think before they dive into anything, just think about what sort of strategy they want to follow. I'm a big believer in knowing what you want to achieve in the market before you jump into it. So I think there's a lot of mistakes people make if they jump in and they don't have a strict strategy. So from my perspective anyway, getting into the market, there's pretty much two main strategies that most people follow. You're either a passive investor or you're an active investor, someone who's picking individual stocks.
Yeah. That's actually, you're talking about research, that's an interesting barrier. I mean, I've kind of been thinking about getting involved in buying stocks recently, and it's that question of like, do I need to do more research in order to get into the market? I haven't really done enough research. I don't quite know what I'm doing, so I don't want to potentially get involved in that. Do you think there's a different level of research needed between those two strategies of active and passive investing?
Definitely. For people that want to make returns in the stock market but really don't want to spend hours and hours looking at individual businesses and studying their balance sheets and all that sort of stuff, then the passive investing strategy is a really good strategy to learn about. Basically, the passive investing strategy is a strategy where you use you invest your money you diversify across the whole market, and the aim of that strategy is not to beat the market, but it's just to get the same return as the general market. So, like I said, people diversify their money across basically the whole market using market-wide kind of diversified investment vehicles like ETFs or in some instances listed investment companies, and they just usually dollar cost average, which is a strategy where they just show up every so often and they invest the same amount into the same investment over time, that investment that is tracking the market.
So it just builds because
it just builds, and typically what history has proven over a long period of time is that the market itself, most major markets, typically produce an average annual return of between 6 and 8%. That doesn't happen every single year, obviously. Some years it's better, some years it's worse, but over the long term it averages out to that. But definitely if people are looking at getting into the markets then and not wanting to do heaps of research, then passive investing is a really good option.
Do you know what kind of returns that we've seen in the market in Australia over the last couple of years? Is it in that 6 to 8%?
Yeah, Australia is an odd kind of outperformer. I've seen some of the data from marketindex.com.au, and they've found that the ASX, the All Ordinaries Accumulation Index, generally gets between kind of 10 and 13%. I think that's before inflation. But yeah, it's a bit of an outperformer when, like America, I think is at about, the S&P 500 is at about 7 or 8% per year over the long run. So yeah.
That's a hell of a lot more than the 2.25% I'm getting at the moment in 86,400. Okay. And then, so that's investing in things like ETFs. How easy is it to set yourself up in a situation where you can purchase assets like that?
It's really not that hard, and I think a lot of investors in Australia kind of get scared because they don't know what they need to do first up, or they don't know like what are the steps that you need to go through. But basically, to buy shares in Australia, you need to have a brokerage account. All 4 of the major banks offer share trading services. You can open a brokerage account with them. Some of those big 4 banks, if you're already a customer with them, then they give you little perks and bonuses if you also keep share trading with them.
Yeah.
But it's really about starting your brokerage account, defining your strategy. If you're a passive investor, then you probably know you're looking at market tracking kind of investments. What market you track, it's up to you. Kind of what if you want to go ETFs or listed investment companies, that's up to you. But I'd start researching that sort of stuff, and then it really is. That's the thing about the stock market. It's easy to get in and out. It's very liquid, so you could buy shares literally in 10 minutes.
Yeah.
And you could be tracking the market already.
Okay. Yeah. What's the difference between ETFs and listed investment companies essentially? Or are they kind of the same thing?
ETFs, exchange traded funds, are purely passive in their approach. So they'll take investors' money, and say you've got an ETF. All ETFs have an investment objective. Mm-hmm. So they all print it on their label. This is our investment objective, which is obviously what they try and achieve.
They're like a branded strategy.
Yeah, exactly. Usually the ETF will say, we are trying to mimic the performance of this index.
Yeah.
So for example, you might have one that tracks the ASX 300, and their investment objective will be to try and mimic the performance of the ASX 300. By buying into that ETF, the ETF will then go and buy across all those 300 companies.
Like representative.
One share of that ETF represents small ownership in lots of different companies, and it won't try and avoid losses. It will always stay invested in that, because its objective is to mimic the performance, positive or negative. It's trying to get that same return.
Yeah.
So it's very passive in that nature. Over time, the market goes up and ETFs kind of go up exactly the same as the market, whereas listed investment companies are actively managed. Again, same idea, invest in the listed investment company, they'll go get lots of different companies in their portfolio, but they've got asset managers that actually pick and choose what companies they want to hold in that portfolio.
Okay.
But very similar. You can see most of major listed investment companies in Australia, AFIC and Argo, and if you look at their performance versus the general Australian market, very, very close over a long period of time.
Oh, really? So there's not a huge, because it seems like higher risk, higher management, higher costs,
exactly
presumably.
Right. Yeah, it is.
But not necessarily higher performance?
Yeah, not particularly. I think it varies based on which one, because they're actively managed. They all get slightly different results, but I think over the long term, over a 10-year view, it's very, very close.
Okay, that's interesting. Yeah. And if you wanted to purchase an ETF on the stock market, is it a similar process to purchasing stocks in Telstra or one of the big Australian companies?
Exactly the same.
Okay.
Yeah, exactly
and you
the
just
same.
hold that.
Yep, brokerage account, log on, and if it's listed on the exchange, then you can type it in and go for it.
Okay. Yeah. So I've dabbled a little bit with kind of share purchasing apps previously, and purchased shares and let them go and then sell the shares and all that. And been in the situation where the apps are charging fees, but some of the apps are charging fees for lack of activity. So say you buy, a couple of grand worth of Telstra shares, and you just leave them sit there, and you want to just hold that value ongoing. If you don't sell other shares, you're getting a fee with this app. So are all apps like that, or are there apps where you can pay a brokerage fee, purchase some stock, and then just own that stock ongoing without any extra cost?
I'm actually not too sure about whether because I personally don't use investing apps very much, because I'm much more involved with my investing now. I pay a lot more attention to it. But I think that some of the apps are good for just beginners to start with, because it's a very easy way. I mean, the idea, especially with most of these investment apps are just focused on passive investing, so they'll just put you in some sort of ETF or basket of ETFs over time. So I think generally speaking, they're pretty good for beginners, because usually while there are fees, usually they keep the fees quite low, and it's an easy way to get people into investing.
To get a taste,
which in the long run, I mean, will definitely help them out. Obviously, you'd much rather be an investor than not be an investor. I think that the fees, I would just have to check kind of on an individual basis
between the different options.
What they are, because you're right, there are some that charge fees for inactivity and little hidden costs. So always check the terms and conditions, kind of thing.
That's definitely the keen advice for any kind of financial transaction. I mean, it's worth saying now that the stuff we're talking about now is just general advice. We're just having a kind of general chat. Nobody should really be going and making investment decisions based on any of this stuff that we're talking now Just make sure don't follow what we're saying.
Don't do that.
So the ETFs are tracking the general growth of the market over time.
Yeah.
If the market grows, the ETFs are going to grow.
Yeah.
We have seen in the economy in Australia some worrying signs with economic metrics like employment and retail spending. We've seen a load of, we've seen Kaufland, which is a big European retailer, which was going to come to Australia. They had a whole lot of property bought, 200 staff hired, and they've decided not to invest in Australia. Seen Big W close some stores, seen Gene West close down. There's trouble in the economy. At multiple different levels, while house prices are continuing to grow, things are a bit messy. Will we continue to see growth in the economy, in the share market through 2020, or is there potentially more risk in that now? Because I know even though things have been going south, the share market has still been growing in value.
Yeah, I think that this is the golden question if you can answer it as to what's going to happen in the share market. I certainly don't claim to know what's going to happen in the next year. But I think my personal opinion is if we're going to see hell, then I reckon it's probably going to come from the United States. I think that we're probably...
Not again.
Yeah, who would have thought? So I think generally a lot of my investing, I look at US-based companies just because they interest me more. I invest less in Australia. More of my passive investing is in Australia. More of my individual stock selection is in the US. Just looking at some of the stats out of the US though, with their broader market, you could even look at the last couple of years of the S&P 500. The price of the S&P 500 has just been going like that, just straight up over time, which over the last few years was okay because you also look at the earnings of the S&P 500 as a whole, and it was going like that. The interesting thing that I've found in the last year is that in 2019, the S&P 500 grew by 28%, which is ridiculous that's the 500 biggest companies in the United States.
In 1 year?
In 1 year, 28%,
wow.
Which is staggering. But what I get confused about is that while the market's doing this, the earnings of those companies was going like this, and now it's gone like that. And now it's actually going down a little bit.
Right.
So that in itself doesn't mean that the US market is overvalued, but it just means that obviously the price is increasing much more than the earnings are. It'll be very interesting to see because obviously we're still waiting on Q4 earnings to see how the 2019 rounds out for the S&P 500 earnings. But it certainly means that investors in 2020 are expecting the earnings of the S&P 500
to follow suit,
to grow. Otherwise, I mean, that discrepancy, how far can it go? And
I wonder, is that like the growth in the perception of value? So there seems to be a growth in perception of value rather than growth in earning, actual earning numbers in companies. Is any of that fueled by the kind of Trump administration and their big cuts on like high income earners and kind of making it easier for companies to make a profit without paying so much to the big government? Is that kind of fueling it?
I think that's an interesting thing about politics in the markets at the moment. I don't know much about politics, but what we've seen is that Trump in particular, throughout the last couple of years, one of the things he's loved to say is, look at how good my economy is.
Yes,
kind of Which I've seen, for instance, my perspective is that where I see the markets at the moment is that the markets are quite overvalued, particularly stemming from America. Not so bad in Australia, but then again, our economic growth and stuff doesn't really look too crash hot, so I think that's fair enough. But what's interesting is a lot of people are saying that in America, they probably see the market, cooling off based on historical measures like a cyclically adjusted PE ratio, which in America is called the Shiller PE ratio. Typically, it's at about 16, which means that investors, or the price of the S&P 500 usually rests about 16 times what the earnings are. At the moment, we see that number is 31. Wow. So investors are basically...
And the norm is 16.
16. So investors are basically, resting for half the value out of the S&P 500 as per normal.
Right.
And this number is leading a lot of people to kind of say, whoa, guys, like valuations are stretched so far that if the earnings don't do anything, like we're really at the limit. For instance, for an example, the only 2 times we've hit that number past 30 in the past was in 1929 and in 1999. Great Depression and tech bubble. So that doesn't mean that the market is going to crash. It just means that we are hitting that limit of the stretch where investors are comfortable with how expensive the S&P 500 is. However, on the flip side, so that's kind of my reasoning behind, I think that in the future we're probably looking at at a lower return environment than a higher return environment. I think there's probably more probability of the stock market dropping down than going up. However, the opposing kind of view, which we were just talking about with Trump, is that, Trump has been saying, look how good my economy is for so long.
Yeah.
So there are people that think that he will do everything possible in his power until the election to just keep the markets afloat, keep them going up.
Right, okay.
So it doesn't look bad.
Because if they are afloat, it's him who directly gets all the praise.
He stands up and says, thank you very much. Yeah, that was me.
That sounds a bit ominous. That pattern you're talking about there kind of reminds me of the government bond yield curve situation in the US and Canada, where the yield curve flipped last year, where you're getting a higher return on kind of shorter term investments than longer term investments. And that pattern also follows preceding previous recessions. So those two together are a bit ominous. So that leads me on to the next question. Then you're saying that the market might lose value. You might see a potential negative effect in the share market. How should that change an investment strategy? It doesn't make any sense at all, really, to get into a market where there's this potential for an implosion.
Well, that's the interesting thing, and this is something that I get asked a lot about on YouTube. Is what do we do? Everything's saying, look, this market's, especially the US, is screaming that it's overvalued. Do I just not invest? You get that pressure from the other side of people thinking that keeping my money in a savings account is not doing anything at all, which is kind of also correct. So people are stuck in this view. The interesting thing is that from my perspective, I don't actually think where the market is at changes your investing strategy at all. And the reason I say that is because I follow two investment strategies. The first is that passive investing strategy, which we were talking about before. And the other one is the active investing. I try and model it more towards the Warren Buffett style of finding high quality businesses, buying them only at margin of safety kind of prices. But if you look at for the passive investors out there, if they're following a dollar cost averaging strategy, which says you're trying to get the market average return, then it doesn't matter whether the market's up, down, or sideways. That strategy to get the average annual return over a long period of time, the only thing that matters is that you just keep showing up. So maybe you invest every 6 months. Maybe, as an example, you plonk $5,000 into a market-wide investment every 6 months. Because you're trying to just get the average, you're not trying to beat the average at all. You just keep showing up and just keep investing. So that's kind of my reasoning behind why I don't change my investment strategy, even though we might see poorer conditions. The other reason is because I don't know if we will see poorer conditions. We could see the market go up another 20% before it comes down, or who knows.
Where's your crystal ball?
Well, my crystal ball is, I kind of can see the reasoning behind trying to keep the markets going until the US election, just from Trump's standpoint. But I think I never like to look at the short term. I think short term is anything under a year. I kind of like to look either medium or longer term, like 5 to 10 years. I think if we look over the medium term, I wouldn't be surprised if we saw the markets lose a fair bit of their value. Quite simply because the classic valuation measures just across the broader market are really stretched to historically what is seen to be almost a maximum tolerance.
So like, if the markets are going to lose a part of their value, but you're investing in kind of continuing to put money in the pot to follow the standard growth of the market, but the market's losing value. How's it kind of possible?
How does it make sense? Well, the way I go about my investing is I don't plan to sell anything for a very, very long time.
So long term.
Long term. I think that if you're trying to be a short term investor in the stock market, like, good luck, because I think it's very, very hard. Well,
you need to be really lucky.
I haven't found any strategy where I can accurately know what's going to happen. But the things that from my research over the last couple of years that I've learned is that the two things really that I've found to be true is that over an extended period of time, no matter kind of where the market is, if you fast forward 20, 30, 40 years into the future, the market will trend up over that time out of most major markets. And the other thing that's true is the Warren Buffett style. If you buy high quality businesses, businesses that you understand that have competitive advantages, have good management teams, and then you take those businesses and you buy them only when you can get them at, say, a discount value or a margin of safety value, then if you can buy a few of those stocks, then that's the other way, where in the long run, over 10, 15 years, then you come out on top.
Okay, so you've said a phrase. So I wrote this phrase down when you said it earlier, and you said it again there. So I'm like, okay, I need to ask about it. So margin of safety price.
Okay.
So that makes sense as a phrase. But how do you know that you're buying a quality stock at a margin of safety price? How
so quality,
do you judge that?
Quality is all about, first of all, I've got to be able to understand the business.
Yeah.
That's key to me. I never invest money in anything I don't understand. That's a big part of lowering your risk, is just to make sure you know what you own. That's a classic Peter Lynch phrase.
Yeah.
Then secondly, you have to have a company, once you understand it, you understand the financials, the industry and whatnot, you've got to be able to see a competitive advantage in that company, because a competitive advantage is basically a shield where if they're in a jostling industry, everyone's battling for market share, but everyone else is making cars, but you're making a car with a difference, some sort of advantage, or something about your business model that's got some sort of advantage in it, then that naturally protects you, so you can focus on growing the business. Then the third part is looking at the management team, making sure that they operate with skill and integrity. Yeah. That's really what I classify as a high quality business, those first 3 points. And then after that, once you've got those three kind of tick boxes, then it's about margin of safety prices. And that's where you have to do a bit more research, and it does take more time, where you kind of look at valuation strategies like Warren Buffett's owner's earnings calculations or a discounted cash flow, those sort of valuation methods to try and work out a range of where you believe the company is fairly valued. And then you only buy it when it's trading at less than what the fair value range is.
Okay, so you look for it to go down potentially.
Yeah.
So you're looking at some company like you're talking about the motor industry and differences. Look like Tesla. So Tesla doing something very differently than anybody else. Got a pretty unique brand managed by somebody who seems to know what they're doing. So all that stuff would be a positive argument to buying them. But then you see Elon Musk smoking a spliff with Joe Rogan on his podcast. Maybe that's a negative argument to go towards them. So it's kind of balancing the two.
Yeah, exactly right. And Tesla's that interesting one as well, because especially being a company that flirts with like profitability or not profitability, like good luck if you can get an accurate or even close to an accurate valuation on that.
Yes.
I think, I've tried and I don't think I can. So if like for me, I am a Tesla shareholder, but I always kind of deem that investment to be more speculative. Like I don't hide from the fact that, okay, yes, I've got this strict strategy, but there's kind of obvious things about like this company that don't quite hit that strategy. So you have to always think, okay, if I'm going to invest, I have to be comfortable with saying, that's a speculative investment.
Slight gamble.
Keep less of your money in definite. So the rule I generally follow is try and keep less than 10% of my portfolio in speculative businesses.
Collectively or
collectively?
Okay,
collectively.
That's interesting, but there's a lot of companies like that now. Like so Uber, for example, a lot of people have a lot of shares in Uber, but like, what is that really worth? It's not making money. It's not been making money for a while, but it's everywhere. I got an Uber here this morning. I'll get an Uber later. I get Ubers all the time. It's such a ubiquitous brand that like I've been to so many conferences where people talk about new companies they're launching and go, we're going to be the Uber of this industry, and it's kind of become a tired phrase now. But they're still not making any money. So is that a sensible investment? Is it not? It's difficult to even know.
It's super hard, and that's the thing about new companies. I tend not to look at new companies. Like I like things to be as predictable as possible into the future, and I think that finding high quality businesses at margin of safety prices helps with your predictability. Things like competitive advantages helps with the predictability, because ideally with a business with a competitive advantage, they don't have to battle too hard against their competitors, because they've got that advantage protecting them. So hopefully that helps their financials be more predictable out into the future. But I typically tend not to look at very new companies. I don't ever look at IPOs. That's just a thing that I just don't do. Quite simply because
not a big crypto investor then either.
No, I'm not a big crypto investor. I'm not at all a crypto investor. But I don't like looking at brand new companies simply because they don't have the financials or the data going back over time to show like what the management has been able to do with the company, or show like is the competitive advantage proven in their numbers, that sort of stuff. So.
Okay, I mean that all makes sense. And if you want to avoid all of that, weighing up the true value of a company and its true valuation, then you can just go back to ETFs. So you've convinced me, right? I'm going to take some of that cash. I'm going to stick it in, take it out of that 2.25% savings account and stick it in an ETF potentially.
don't listen to what I'm saying, but I'm glad that you've decided to do that.
Okay, yeah, you'd no influence on it at all, but I might just do that anyway. It's been a pleasure, Brandon. Thank you for that interview. And guys, you can see any links to things we've talked about in the description below. Follow more financial news on Finder and indeed also on Aussie Wealth Creation.
Finder.com